Hi guys, welcome back. Now in this video we are going to be discussing a very important topic that was also tested in May June 24, paper 22 in the macro section C, and students also find this topic confusing, so I thought that I'll make a video on it and I'll just once and for all end this confusion. So this will be a comprehensive video on this topic and should probably clear all your doubts, so make sure that you watch it till the end. Also, if you haven't subscribed to my channel, please subscribe my channel and press the bell icon as well so you get the regular updates, and share my channel with as many people as possible so that they can also have an update on whatever is happening here. And if they want to improve their concepts without paying for anything, they can use my YouTube channel for a lot of things. Now guys, moving forward, what we need to do is that we need to first understand. So first I'll explain you what the circular flow of income is. We all know what the word income means. We all know what the word flow means. And we also know what the word circular means. Now, the circular flow of income in a very basic term, although you will not write this down, but it's just telling us how the income is flowing in a circular motion. But when you say that it's flowing in a circular motion, the correct word that you should use is in a loop. So basically, when we discuss about the circular flow of income, how income is flowing in an economy or how money is flowing in the economy, economists divide economies into two types, that is closed economy and open economy, right? And when you talk about a closed economy is a very idealized form where there is no external trade there are no external activities, like there is no import or export. And it is focusing purely on the internal transactions of the economy, right? Now, a closed economy could involve the government as well, that is the state. The state as a key player in doing economic activity. However, the open economy is basically engaging in international trade. That is, it is engaging in imports and exports, such an economy, right? Affecting obviously domestic economic cycles and with its external economic activities like imports and exports. So that's what an open economy is. So whenever you're answering a question on circular flow of income, and the question focuses on the circular, because when they're asking about circular flow, they will specify whether they want an open economy to be or a closed economy. And usually in most cases they would mention open economy, because generally open economy involves the external sector as well, right? So it gives a more holistic view. So if they want to test you guys, so they will definitely test you on open economy, although you must also, because closed economy is just a very simplistic model. Anyways, so you need to define not only what circular flow of income is, but you also need to define what closed economy or open economy is as part of your assessment objective 1, if you're answering any past paper question on this topic. Okay guys, so the circular flow of income is basically a model. It's a diagram. It's basically, economists love models, right? They explain it either through mathematically, or they explain it in theory, or they explain it through diagrams, that is, they explain it through different models. And this is a model that illustrates the continuous flow of goods and services and money among different sectors of an economy. Different sectors means the households, the firm, the government, and the external sector, right? And this model is basically helping us understand how the whole idea behind a circular flow of income is to help us understand that how GDP is generated. That is how national income is generated in an economy. How income is generated, how the nation's income is generated, that is GDP is generated in an economy. Not only how it is generated, but also how it circulates within an economy. That is what the circular flow of income is modeling us. And so now we will begin our discussion with starting a very basic model on the circular flow, that is from a closed economy where we only have households and firms, because we are going to be introducing a very simple model first, right, known as the basic model, without the government basically. So, and this model will just talk about households as providers of the factors of production and also representing them as consumers of goods and services, while firms would be the producers of goods and services, while also at the same time they will be payers of the incomes, that is they'll pay factor income to the households. But before I explain a bit more on this, I want you guys to understand, before we talk about this, that national expenditure in an economy, right, the national expenditure, total spending in the economy basically, equals to national income. That is the value of the national expenditure in economy equals the value of the national income, which also equals the value of your national output, right? Now guys, if you want to understand the circular flow of income, it is mandatory that you understand what all these three are and why do we say that they are equal, right? Because you need to understand that when you say that national expenditure equals national income equals national output, you are basically demonstrating a very fundamental or a foundational concept in macroeconomics, which is, telling us that because this concept is just revolving around that, all the money that is spent in an economy, number one, must come from somewhere and then it must go somewhere. It must come from somewhere and then it must go somewhere. And this equivalence that it must come from somewhere and then it must go somewhere is crucial for understanding, and the equivalence that these all three are equal is crucial for understanding how economies function, how macroeconomies function, and how they maintain their balance, over time. And so if you talk about national output is simply your real GDP. It simply refers to the total value of all the goods and services that are produced within an economy over a specific time period. Simply, that is measured by your GDP. It is simply your GDP. That is your national output. And it represents the aggregate production side of the economy, right? While national income is simply the total income, the total amount that is earned by the factors of production. So whatever total amount that is earned by the factor of production, that is your land, capital, land, entrepreneurship within an economy, that's what national income is all about. So it includes your factor incomes, right? It includes your wages, your rents, your interest and profits. That's what national income is. So it's basically essentially the sum of all the incomes that is received by households and firms in an economy. While your national expenditure is basically, national expenditure could also be called as aggregate demand. So it could also be called as aggregate demand because it is simply referring to the total spending on a nation's output of goods and services. And it comprises of consumer spending, investment spending, business spending, investment spending by the business, government spending, and net export spending. So right now when I'm explaining national expenditure equals national income and output, I'm not really focusing on a closed or an open economy. I'm obviously assuming an open economy with international trade as well, because I'm obviously taking I'm mentioning net export, so definitely. But when you say that the equivalence of national output, income and expenditure, it basically stems from the very basic, principle that all the output that is produced in an economy, that is the national output, that is produced in an economy, that is your GDP, must be purchased by someone. That is your national expenditure. It must be purchased by someone. That is your national expenditure. And the money that is spent on purchasing that output must ultimately be received by someone as income, which becomes your national income. And if you break each component down and you start to connect it, and you see that from output, how do we arrive at expenditure? So you could say that every good or service that is produced by an economy, that is the output of that economy, is put on the market to be sold. Now I'm explaining all this in a very simple way because you're AS students. Otherwise, if I would be making this video for A2 kids, probably I would be using a bit technical terminology or explaining in a much deeper way. But this is, for you guys, it's much simpler explanation. So every good or service that is produced by an economy, that is the output of an economy, is obviously put on the market to be sold. That's what I said. And when these goods and services are purchased, then obviously expenditure equals the value of the output. So when you're saying that, so your national output, that is your GDP, basically it has a value, right? So we're saying that the expenditure made on an economy equals the value of the output sold, right? So imagine that, let's say there's only one chair in an economy that is produced. That must be sold to someone. And the value of the chair is, I don't know, X dollars, let's say. And so the national expenditure in an economy would equal the X dollars that are spent on purchasing that output of chair, which is for X dollars. So the value of that output, that is chair, which is X dollars, equals the expenditure made, that is X dollars, right? And obviously the expenditure that is made is income for someone. So the money that is spent on buying these goods and services, that is the expenditure, it then flows to the producers as revenue, which is then distributed as incomes in the form of, what I'm saying is that the money that is spent on buying these goods and services, that is the expenditure that is made, it flows. Flows. There's a reason why I'm using this word flows, because I'm explaining the circular flow. So it flows to the producers as revenue, and that revenue is then distributed by the producers as factor incomes, such as wages, such as rent, such as interest, such as profits. And it is distributed as factor incomes to the factors of production, which is obviously virtually provided by the households, right? And so from income, we get back to output, right? So from output to expenditure, and then from expenditure to income, and then from income we get back to output, and then again from output to we'll get back to expenditure, and then to income, and then to output. So everything is moving in a loop, right? In a circular motion. And when you say that from income you get back to output, what you're saying is, and so the income that is received by the factors of production could either be spent on consumption, or maybe it could be saved. So this is a very basic explanation. So when you're saying, so again, so the circular flow of model, basically, I'm going to be explaining you what the circular flow is. So the circular flow of model will also explain why national expenditure equals national income equals national output. That is exactly what circular flow will explain as well. That the spending that is done in the economy, total spending in the economy, is equal to the total income in the economy, which is equal to the GDP of the country, that is the value of the output, right? And this would be demonstrated by the circular flow, or this would be modeled by the circular flow, right? In a very simple manner, because the circular flow is showing how money moves through an economy between producers and consumers, let's say, creating, when you say between producers and consumers, you're assuming a two-sector model, creating a continuous loop of transactions that, balance each other, right? And so when economists say that GDP, you could measure GDP, or you could measure the value of the output either by measuring the total spending in the economy, that is your total expenditure made in the economy, or you could measure GDP by adding up all the factor incomes. That is, GDP could be spending based, or GDP could be income based, and both will give the same totals. That is, GDP calculated based on adding up all the spending done, or GDP calculated based on adding up all the factor incomes. And so what it follows is, and that is exactly why you say that your GDP, that is your national output, or the value of your GDP, would equal the value of your national expenditure if you have calculated GDP by adding out all total spending. Or you could say that the value of the GDP would equal the value of the national income, right? And since the value of your national output, that is GDP, is equal to the value of your national expenditure and is also equal to the value of your national income, that is why national expenditure would also equal national income, right? And it makes perfect sense. And our circular flow model is exactly going to tell us how this works. How do you arrive at GDP? What is GDP? Who is producing these goods? Where is money coming from? How is income generated? Why is it generated? And then why is the spending being done? And how are they equal? And if something is equal, then something is moving in a loop, balancing out each other. And that is what is modeled by the circular flow of income in an economy. Now guys, what you see over here is a very basic model of circular flow diagram of a closed economy with, let's say, no government playing any part in economic activity. So to simplify things, we're only assuming that we have two key players in an economy, households and producers, right? And so first understand who households are. Households in the circular flow model, they represent all individual consumers in an economy. Not only that, they're also the owners of the factors of production, including land, labor, capital, and entrepreneurship. And they are basically, these households, they provide those factors of production to the firms because they are required by the firms to produce the goods and services. So when you talk about households basically provide those factors of production. That is, they supply the labor to firms, they lease out their land, they lend the capital to the firms, and offer the entrepreneurial skills that are necessary for the production processes. Right? So households in a closed economy are not just passive recipients of goods and services. They are actively involved in the economic process by providing the essential factors of production. That is, let's say, labor. So households will supply labor to firms, which is a primary driver of production activities. Again, households will provide the necessary capital that firms will use. They will provide the necessary land, right? The natural resources owned by households are leased or rented to firms for productive uses. And households will also contribute to the entrepreneurial skills, taking risks which could include taking risks to start new firms and, coming up with new innovations. And then households will obviously, and in exchange for the factors of production, in exchange for the factors of production that households will provide, right? Households will receive incomes by the firms in various forms, such as wages for labor, rent for land, interest for capital, and profits from entrepreneurial activities, right? And then household will definitely consume goods and services by using their income to purchase the goods and services produced by the firm, right? So firms will basically, like I said, firms will transform that input provided, the factors of production provided into, they will basically convert it into finished products that they will sell it to the firms, right? So guys, if we try to look and understand the flow, right? If you look at the flow that is taking place in this model, there are two types of flows taking place. One is the real flow and the other is the money flow. Okay, so the real flow talks about, the households providing the factors of production to the firms, and then in return for the factors of production, firms producing those goods, which are then consumed by the household. So this is again completing the loop, the circular loop, because households providing factors of production to the firms, which includes labor offered by individuals, land or natural resources, capital and entrepreneurial skills, and this flow represents the input side of the economy, which is with the households offering those factors of production to the firms. And then the firms in return for the factors of production would produce those goods and services, which are then consumed by households. And this then completes the real flow cycle, as the output that is produced by the firms using the inputs from households is ultimately consumed by those same households. So this is just one sort of flow. And then the other flow that we see is the money flow, right? Because we see that money is flowing from firms to households, right? And so, for example, the flow of money from firms to households is in the form of factor incomes. And so in exchange, you use the word exchange in the exam, in exchange for the factors of production that households have provided, firms compensate them, right? In the form of, and that is basically representing income paid for factor services. So we see, the money flowing from producers to households. This is basically compensation that is distributed in the form of wages for labor, rent for land, interest on capital, and profits to the entrepreneurs. So this flow of money represents the incomes that are earned by the households from their economic contributions that they do by providing those factors of production to the firms. And then we see that households then use that money that they have earned. The households will spend their earned income basically on the goods and services that are provided by the firms to these households. So this expenditure by the households then flows back. It flows back to the firms, providing the firms with revenue. And this spending is basically representing, the payments for the, goods and services that are done by households. And if we imagine that this is the only spending that takes place in the economy, so this could be represented as a total spending in the economy. And if we say that this is the only income that is generated in the economy, there are no external players, there is no government, and this would represent total income generated in the economy. And hence, we could say that total income that is generated is again flowing back to the, it's basically balancing out as it's completing the loop because it's equal to the total final spending. So again, this proves the equation that your income is equals to spending, that is national income equals to national spending. And if national income or if income equals spending, then this is economic equilibrium in this circular flow in a basic model. Because technically what's really happening here is that the value of the output that is produced by the firms is bought by the households from the factor incomes that are paid by the producers to the households, and that is spent back from on the firms. All of that, we're assuming all of that is spent, right? And so the circular flow model economic equilibrium is achieved when the total output that is produced by the firms, that is the producers, the output, the value of that output that is produced by the producers is exactly equal to the total expenditure that is made by the households on that output. And similarly, economic equilibrium is achieved when the total income that is received by the households from the firms should equal the total amount households spend on the goods and services, right? So again, incomes equal spending, and that is again equilibrium. And so this is representing a balance in the circular flow, and this balance ensures that the economy is stable. In other words, this is representing macroeconomic equilibrium. In other words, this is representing there's no excess or deficiency in, total or aggregate demand or supply in the economy, right? So you see how these concepts are connected. And when we are studying circular flow of income, basically, especially in a closed economy, in a very simple, basic model, we are basically assuming three things here, right? And I'm going to write this down. So the assumptions are, we're making three very critical or crucial assumptions here. And the assumption is that there is no saving taking place and or no investment. So that is the first assumption. There's no saving, that is no investment. What this means is that all the income that is received by the households, all this income that is received by the households is immediately and entirely spent back on consumption, right? Not only that, so there's no saving taking place. Households are not saving the income that they're receiving, they're spending it back on consumption. Similarly, we're also assuming that whatever revenues the firms are earning, because these payments for the goods and services are acting as revenues for the firms are using all those revenues back into production, right? So since there is no saving in the banks or financial institutions by these households, nothing is lent out by the banks to firms for investment as well. So there's no saving or investment taking place. So this is a very simple sort of model thing, happening here. So this is a very basic sort of thing that we're trying to explain. The second assumption that we make is that there is no government here, or there's no external trade as well. External trade would take place in an open economy. So the model is assuming there's no government intervention or foreign trade, and what this means is that there would definitely be neither. There are no taxes, there's no government spending, there are no imports or exports, right? So we're just focusing on the private sector's internal transactions between households and firms, which obviously means that we're saying that your economy is a closed economy, and closed economy again means that, so this is no external trade is again simply referring to the same thing, closed economy. The economy is basically self-contained, meaning that all economic transactions occur within it. There are no external influences. And so these are assumptions that we're making for explaining a circular flow model in a closed economy. And so guys, it follows that in a basic two-sector model, the households are spending the money, like I said, to purchase those goods and services from the firms, which basically counts as national expenditure of an economy in a very basic two-sector model in a closed economy. And the reason is that since households are the only main consumers here. So the money they spend to purchase the goods and services from the firms, that represents a national expenditure, in the economy, because the spending ultimately activates, the production process, and so this expenditure then is the primary driver of economic activity within an economy, because that's the only consumer expenditure. We don't have any government spending, we don't have any investment spending, right? There are no net exports, so that is the only driver of economic activity in a macro economy. And so the total consumption by the households is then the only and the crucial component of the GDP in the economy, because then this expenditure that is done by the households, which is the entire national expenditure here, otherwise national expenditure in an open economy or in an economy where you have government and external influence factors as well, so that would include investments and government spending as well and all of that. And so the total consumption here by the households is a crucial component of GDP. I mean, so because this expenditure is going to stimulate production and help, maintain growth and stability in the country. So it's basically illustrating the demand side of the economy, right? I mean, if this is the only expenditure, then this would represent aggregate demand. The national expenditure would represent the aggregate demand in the economy. If this is the only spending that we're assuming that it's we are making, and then the firms pay households for the use of their labor and other resources, and this constitutes national income, right? Because when the firms pay the households for the use of labor and resources in the form of rent, interest, and profits, that constitutes the national income earned in the economy. Because this money is flowing back to the households, rewarding them for their factor inputs. So, and the implication is that, this flow of income is, again, this flow of income is critical also for sustaining economic activity. Just like expenditure, we said that over here, expenditure was critical in sustaining economic activity. Here, the income is critical in sustaining economic activity. Right? And so, since it's balancing it out, so we are saying that the economy is in equilibrium because they both are equal. Right? And so, the total output by the firms is acting as a national output of the economy or the GDP of the country, because the total goods and services that the firms are producing, which are then purchased by households, they are representing national output. That is a GDP. And this output is essentially, what is this output? This output is just the sum of the goods and services that are produced within an economy over a specific time period, right? So, again, what we're saying is that this is so important because, again, the expenditure by the households determine the revenue for the firms, right? And that the income generated by the firms, it circulates back to the households. And the aggregate of the goods and services produced by the firms, that is fueled by consumption expenditure, the household expenditure, that comprises the total economic output. And so this model is simply proving that national income equals national expenditure equals national output. And if you're saying that the economy's total spending is equal to the economy's total output and equal to the economy's total expenditure in a closed economy, then the economy is in a macroeconomic equilibrium. And now, guys, I want to bring your attention back on this diagram where, you see, initially we were assuming that all the income earned by the household is spent back on all the output that is produced by the firms. But in the real world, that doesn't happen. And to make the circular flow diagram more realistic, that we must also factor in that households do not spend all the money, they actually save as well, right? Therefore, we basically represent in the diagram of a circular flow something that is the term financial institution or the financial system. And this financial system basically represents the banks, right, in the economy. And so what happens is that households save in these banks, right? They don't spend all the income on consumption. In fact, they save some of it in the banks, right? And so the money that they save in the bank is then passed on to the businesses by these banks. It is lent out to the businesses. So ultimately the money passes back to the businesses, right? And businesses then use the investment funds that are obtained from these financial institutions to make their investment expenditures on capital goods and stocks, right? And so savings is basically representing a leakage from the circular flow. It's a leakage because the initial flow was saying that all the money earned by the household is spent, but then some of it is leaked out, and it goes to the banks instead of being spent back on the output of the firms. But then it channelizes back, or it is recycled back into the system through investment by the firms, right? And we represent the investment, we say that investment is basically an injection. And the reason why we call it an injection is because, we basically call it as an injection because it is basically, representing an addition to the circular flow, or an addition in the circular flow which does not relate to the present consumer spending, right? So the thing is that, and so saving is basically a leakage while investment is an injection, right? And so the investment that is done by the businesses basically on capital expenditures, on basically capital goods and stocks, there's basically the spending by the firms would form as part of the total final spending, right? And so the thing is that like businesses since the firms end up as part of investment, they end up producing the capital goods, right? So the actual production of capital goods or investment goods also generates income in the economy in the form of wages, rents, interest, and profits, which will ultimately go back to the households, right? And will hence be included in the total income that is generated, right? So you see how, the loop is complete again, right? The saving that is done is injected back, right? Again, restoring equilibrium, but a higher level of equilibrium this time, because the investment is creating further incomes, right? And so once again we see that the national income is equal to the national expenditure made, and hence the national output, they are all at the same level again. And so guys, the circular flow diagram is very simply modeling how the economy's macroeconomy is functioning if we include leakages and withdrawals into the flow incomes, into the circular flow as well. And in economic terminology is simply a leakage. Basically leakage is any use of income that does not return directly to the expenditure stream, right? So any income that does not directly returns into in our expenditure stream would be considered a leakage. And in the context of our closed economy model that we have tried to explain over here, the savings are representing a leakage because households, like I said, do not spend all their income on consumption, and a portion of that income that is earned from providing labor and other resources to the firms would be saved, and hence this saved portion represents a leakage. And we're calling it a leakage because it is removed from the immediate flow of expenditure on the goods or services, right? While the injections over here, like this investment, is basically the injection is basically an addition to the income flow, that does not, and we're calling it an injection into the income flow, which is not originating from the households. That is why hum isko injection, that is why we call it an injection basically, because it is not originating from the household consumption expenditures, right? And so firms invest the saved money into capital goods to maintain or expand their production capabilities, right? And investment is considered injections as they are representing what? It's representing it's an external addition, right, to the expenditure stream. So it counters the effect of savings basically. And so, equilibrium basically in a more complex circular flow model where we have investment and savings as well, equilibrium would be achieved when the total leakages equal total injections. That is, your savings is equal to investments, or you can say your leakage equals to your injections, right? And so specifically in this model, the savings by households must be equal to the investments made by the firm, right? And so what really happens is, the mechanics behind this is that since households save the money and that money becomes available to firms through banks in our simple closed economy, and the firms use these funds to invest in, firms basically use these funds to invest in capital goods, which not only maintains the capital stock of the economy, but also, potentially increases the economy's productive capacity as well, which is obviously good for growth. And so what then happens is that the investment done by the firms, it ensures that the money that is leaked out of the consumption stream through these savings, is injected back into the economy, and it contributes to economic output, right? By replacing the depreciated capital, or by expanding on the existing capital, which eventually leads to an increase in production and the productive capacity as well. So when households are basically saving a portion of their income, initially what happens is when households will save, it will initially cause a reduction in consumer spending. And this reduction in consumer spending could result in a decrease in demand because it would, reduce the firm's revenues if it is not offset by other expenditures. But ultimately, the equilibrium will be achieved, because what will happen is that the firms will respond by investing the equivalent amount of savings into productive activities, right? Into productive activities, which will maintain the demand for capital goods in the economy and also stabilize, the incomes for, you can say, other firms who are actually involved in producing these capital goods, right? And so over the long term, what will happen is that the economy will witness stable growth, because by investing the savings, then firms are enhancing their productive capabilities, which is leading to growth and output over the long term. And this growth can lead to, again, increased incomes for households as well, right? Like I said, this investment will result in further increase in incomes, which will be part of the total incomes generated in the economy over here, right? And the increase in incomes for the households as well can lead to higher consumption, again, will ultimately lead to higher consumptions in future, but at the same time also leading to higher savings in the future as well, which will again perpetuate sort of a cycle of growth in the economy. And so when you say that the equilibrium in an economy which is represented through the circular flow will ensure that all the saved funds are recycled back in the economy through investments, and this entire recycling stabilizes the economic cycle for the country, for the economy, again compensating for the reduced consumption due to savings, right? Because it will be offset by investments. The fall in C will be offset by a rise in I. And so by investing the savings, firms are not only replacing the worn out capital, but they are also potentially expanding their productive capabilities or capacities. And this will actually lead to growth in output and incomes for the economy. Hence, national output and national incomes will rise, which will, foster a stable economic growth. You can say, a stable economic growth trajectory for the country, right? So the economy will ultimately lead to a higher newer equilibrium, basically, right? Now, guys, the fact that injections equals withdrawals is macroeconomic equilibrium, we could actually, basically injections will equal, withdrawals, or in our two-sector closed economy, we are saying savings equal investment, right? We said that we can actually prove this as well. So, for example, your income, that is Y, could either be saved or consumed. So Y equals C plus S. And you see, income can be generated in only two areas of production, that is only two areas of output. That is by producing consumer goods, when we're calling it C, consumption or consumer goods, right? By producing consumer goods, because now we're looking from the production side, or by producing investment goods, that is I, right? So you see, and we could, if Y equals C plus S, but Y also equals C plus I, then we can actually put this over here in this, on the left hand side, and we can rearrange this by saying C plus I equals C plus S, right? And hence it follows that C gets cancelled and you have I equals S. So you have investment equals saving, and this is your macroeconomic equilibrium. But if investment will not be equal to saving, let's say, which means that your investment is more than saving, so it will create inflationary pressures in the economy. So if investment is more than saving, which means injections is more than saving, it will create inflationary pressures in the economy. But ultimately your equilibrium will be restored, right? And so when saving is more than investment, it will create recessionary impacts in the economy, right? Although your equilibrium will be restored, but at a lower level of equilibrium. And saving equals investment is, the point where it is your macroeconomic equilibrium, right? So that's it. Now, as far as the government is concerned, I also wanted to introduce the government into this model. And so you guys tell me if you understood this. You want me to also introduce the government into this model and sort of give a bigger picture, and then also make a video on the circular flow for an open economy. And if you want the part 2 of this video, then please mention in the comments. If you guys comment on this video and you tell me to make part 2 as well, then I'm definitely going to make part 2 as well. So that's it for this video, guys. I'll be ending here. I'll see you all around in the next video. Until then, take care.